Hi everyone, Woody here. Well, the global gas market is undergoing a fascinating transformation that most investors have not caught on to yet. My guest today, Nick Hubbell's latest Fat Tell Daily Insight, explains how we're moving from fragmented regional markets to something more integrated and global, and why this could create some interesting opportunities for Australian investors. Now, what caught my attention was how this shift could mean that events on the other side of the world might soon have a much bigger impact on our local gas producers. So let's dive into what this means for investors. Nick, welcome, mate.
Yeah, it's good to see you, Woody.
And you, buddy. You've described how gas markets used to be highly localized, with prices sometimes diverging by factors of 8 between regions. What's driving this shift towards a more unified global market, and what are the investment implications?
Yeah, I think what's really changed for the gas market is how much of it is seaborne, is ocean going, is on these big LNG tankers. And also, obviously, part of that is the amount of import terminals and the amount of different countries that are available to be used by those tankers. And so, what we've got over the past few years, largely because of the Russian energy crisis, is a shift from think of it as a pipeline sort of business where, there's a pipeline built between Russia and Germany. And so that's it. Those two countries are sort of tied at the hip. Now we've got a system where a gas producer or a gas exporting country, as long as it has an LNG terminal that's pretty big and so there's enough tankers available, can sell its gas anywhere, right? So we've gone from a market where people are tied to each other to a global, international, fungible, diversified, all these different words to describe it. And this means there's going to increasingly be a global price for gas rather than lots of different separated different prices in different places. And so in the past, when there's been a gas price crisis, a shortage or a price spike, whatever it might be, if a pipeline's blown up or whatever, or a war starts, it wouldn't really impact gas stocks in places that are in other parts of the world. So obviously a European gas producer would be impacted, but an Australian and American, Canadian one, not so much. Because the gas prices could diverge so much. Well, in the future, increasingly so, because of this globalized gas market, an incident in America or an incident in Europe or wherever it might be will actually move Aussie gas stocks, Aussie gas producers on the ASX. So I think investors are going to have to increasingly pay attention to what's going on in the world, but also that there's this opportunity now, right, that didn't exist so much in 2022. But I think it's going to exist in the future where any disruption to gas markets will be a profitable opportunity for ASX investors owning those gas stocks.
You highlight how new LNG infrastructure is connecting previously isolated markets then, but how might that affect Australian gas producers' pricing power?
Yeah, so increasingly the LNG ships that are showing up in Australian import and export terminals would be able to sell to different parts of the market. So, for example, there was an article that popped up today or yesterday overnight in the Financial Times, and it was an infographic. It was a map of the Atlantic, and it showed 4 or 5 different LNG tankers that had left, I think it was the east coast of the US where they'd got their load, and they were going down south, presumably heading either towards Asia or towards South America to sell their gas. And suddenly they'd all change direction. It's like a V-shaped direction change heading up towards Europe. And what's going on is the European gas market is a bit tight. They've been using their gas faster than usual because of low wind and low temperatures there. And so their gas storage levels are quite low. And so the Europeans are looking to buy some gas. And they've managed to buy enough gas to redirect these tankers that were going to places like Asia, which means there's been this demand shift and this price shift. Whereas previously that couldn't have happened in the same way, or at least as quickly. And so now there's wherever those tankers were going to go to, if it was Asia, there's some gas missing that they assumed was going to show up. And so now they're looking at the Aussie market saying, well, maybe we should buy that gas from Australia instead. So that's a concrete example that's playing out right now of how trouble in Europe in the gas market has shifted the gas supply away from Asia. I'm presuming it was Asia they were headed towards. Shifted it towards Europe, and so now Aussie gas stocks are going to be able to benefit from that.
So basically, local supply might become less relevant to pricing as the market globalizes. What does that mean for Australian domestic gas prices then, and companies supplying our market?
Yeah, that's a complicated, messy story, right? Because we've had these gas shortages while selling so much of our gas
I
overseas,
know
being a
Greg,
major.
our colleague Greg Canavan, has covered that extensively.
Yeah, it's a totally bizarre situation, seemingly so. But if you move to a global market, like I'm arguing today that we are, then it's the global price for gas that matters. It doesn't matter how much you produce, how much you sell overseas, all these, you can't reserve it for yourself. It doesn't work that way. You pay the global price. And so having an import terminal that imports gas might sound totally bizarre, given how much gas we produce. But Australia's a pretty big place, right? And so, having pipelines between different parts of the country is one way to do it. APA Group's a good example of that, and they're doing quite well last time I checked. But the point is that this makes sense in the sense that you create a global market which creates global trading efficiency. But it means that domestic gas prices are going to rise to that global price level. Now, gas price has been quite cheap in Australia compared to many places around the world, especially Europe.
Could be cheaper though.
It could be significantly cheaper. So the question now becomes, if we have a gas price spike because the Europeans and nations need so much gas, well, let's increase supply.
So, how should investors think about this increased exposure to international events then?
I think in the short term, it means that all these messy politics that's going on in Europe is an opportunity for us to profit from. We can make money from the fact that there's this disruption in the gas price market, which is pretty good. I think it makes sense to own some gas stocks for the next few years if you believe that this huge divergence between European gas prices and gas prices elsewhere around the world is going to narrow by way of our prices rising, not just by way of European gas prices falling. So I think that's the big opportunity here.
Are there any particular gas plays on the market that you can discuss for viewers watching?
Not in any great detail, because we'd be edging towards the recommendation story, right? The compliance nightmare. What I'd say is you've got to look for the companies that are going to be producing a lot of gas in the future that's not yet been sold on fixed term contracts, mostly to Asia, to Japan. So you want the companies that have got a lot of unsold future production coming up. That's where I'd focus. There's usually the smaller ones, might be an exploration story and a development story rather than a producer story, because the existing producers are so focused on these long-term contracts. There was another story that I noticed today that they are considering a new export terminal. I think it's a gas export terminal somewhere in Darwin, somewhere in the Northern Territory. It's very early days yet, but anyone who can get their gas to that region of Australia might be in for a significant advantage.
Would there be any broader ETFs to look at?
There are relevant ETFs, but they will also include companies that are not going to be exposed as directly as you might want. So I would suggest that people either take some time to read Greg's work, take some time to read some of our other editors' work to check which companies are actually exposed to the spot price market, the international market, rather than have already sold off their future production.
Fair enough. And just a final question, Nick. You make an interesting comparison between gas and gold in terms of fungibility. How close do you think we are to having a truly global gas price, similar to how gold trades?
Not very close. The question is whether there's enough arbitrage. So what's happening right now with those tankers between the US and Europe is the prices diverge far enough that it pays for a tanker to change course, which is quite a high bar to set. And this should make the prices converge slowly over time. The gas market's still fragmented in many other ways. You still need the ships, you still need the import terminals, and so on and so forth. The gold price is a bit different. There is, however, an interesting story. Perhaps this is next week's Fat Tail Daily, where the gold price in New York and London has started diverging in some strange ways, creating some arbitrage opportunities. Literally, gold's moving between the two places to take advantage of the price. So even the gold markets that is not completely fungible and international in the ways that we might assume. But I think gas, there's still a lot of barriers here. The point is that as the prices converge, Aussie gas stocks should be able to profit.
Well, that's a perfect place to end the chat. Thanks, Nick. There you go. Let us know what you think. So, give us a comment, give us a question, and we'll try and answer it. And do please read Nick's latest Fat Tail Daily, which covers all the points we've been talking about today. Links below, free as always. Hope you enjoy. Let us know what you think. Cheers, Nick. Have a great weekend, mate.